Hello, and welcome to today's video on tax-efficient distribution strategies in retirement. I'm Long Tran, a financial advisor at Compound Planning, and I'm here to help you navigate the complex world of retirement income planning. You've likely spent years saving and investing for retirement, but now that you're in the distribution phase, it's crucial to have a smart strategy in place to minimize your tax burden and maximize your income. In this video, we'll explore the various income streams available to retirees, the tax implications of each, and how to create a distribution plan that works for you. Understanding your retirement income streams. As a retiree, you likely have multiple sources of income, each with its own tax treatment. These may include Social Security. Depending on your other income, up to 85% of your Social Security benefits may be taxable. Pensions. Most pensions are taxed as ordinary income, but some offer tax-free options. Traditional IRAs and 401ks. Withdrawals from these accounts are taxed as ordinary income. Roth IRAs and Roth 401ks. Qualified withdrawals are tax-free, making these accounts valuable for tax diversification. Taxable investments. Long-term capital gains and qualified dividends are taxed at preferential rates. Understanding how each of these income streams is taxed is the first step in creating a tax-efficient distribution strategy. The importance of tax diversification. Many high earners focus on maxing out their contributions to pre-tax accounts such as 401ks and traditional IRAs during their working years. While this can provide a significant tax break in the short term, it can also lead to a tax-inefficient retirement distribution strategy. When all of your retirement savings are in tax-deferred accounts, every dollar that you withdraw will be taxed as ordinary income. That's why it's essential to diversify your retirement savings with after-tax assets like Roth IRAs, Roth 401ks, and taxable brokerage accounts. By having a mix of accounts with different tax treatments, you can be strategic about which accounts you tap into while potentially lowering your overall tax bill throughout retirement. One strategy to consider is performing Roth conversions in lower income years during retirement. This involves transferring money from a traditional IRA or 401k into a Roth account and paying taxes on the converted amount at your current tax rate. If you expect to be in a lower tax bracket in certain retirement years, perhaps before RMDs kick in or in years with large deductions, a Roth conversion can be a smart move. This allows you to pay taxes on the money at a lower rate now and enjoy tax-free withdrawals from your Roth account later in retirement. Factors to consider in your distribution strategy. When creating your retirement distribution plan, there are several key factors to consider. Current versus future tax rates. If you expect to be in a lower tax bracket in retirement, it may make sense to withdraw from your tax-deferred accounts first. However, if you anticipate higher tax rates in the future, drawing from your Roth and taxable accounts first could be more advantageous. Required minimum distributions, or RMDs. Starting at age 72, you must take RMDs from your traditional IRAs and 401ks. These withdrawals are taxed as ordinary income and can push you into a higher tax bracket if you're not careful. Estate planning goals. If you plan to leave a significant portion of your wealth to your heirs, it is important to consider the tax implications. Roth accounts can be particularly valuable for estate planning as they are not subject to RMDs during the owner's lifetime and can provide tax-free income to your beneficiaries. Medicare premiums. Your income in retirement can affect your Medicare premiums. If your income exceeds certain thresholds, you may be subject to the Income-Related Monthly Adjustment Amount, IRMA. IRMA is an extra charge added to your Medicare Part B and Part D premiums if your modified adjusted gross income is above a certain level, $103,000 for single filers or $206,000 for married couples filing jointly. State-specific tax considerations. While federal tax planning often gets the most attention, it's important to understand the tax implications of your retirement income at the state level. Some states are more retiree-friendly than others, offering tax breaks such as no income tax on Social Security benefits, low or no estate or inheritance taxes, property tax exemptions for seniors, exemptions for retirement income like pensions and IRA withdrawals. For example, states like Florida, Nevada, and Texas have no state income tax at all, while others like Pennsylvania and Mississippi exempt retirement income from state taxes. Understanding the tax laws in your state can help you make better decisions about where to live in retirement and how to structure your income. Maximizing your deductions. In recent years, the standard deduction has increased significantly, leading fewer retirees to itemize their deductions. However, if you have significant deductions, itemizing can still be beneficial. Some common deductions for retirees include medical expenses. If your medical expenses exceed 7.5% of your adjusted gross income, you can deduct the amount above that threshold. Mortgage interests. Interest on up to $750,000 of mortgage debt is deductible on a primary home or secondary home. Charitable contributions. Donations to qualified charitable organizations are deductible, and if you're over 70 and a half, you can make qualified charitable distributions, or QCDs, directly from your IRA, which satisfy your RMD and reduce your taxable income. By carefully tracking your expenses and working with the tax professional, you can make sure you're taking advantage of all the deductions available to you. Creating a tax-efficient retirement distribution strategy is a process that requires careful planning and consideration of many different factors. At Compound, our financial advisors specialize in helping retirees like you navigate the challenges of retirement income planning. We can work with you to create a personalized distribution strategy that takes into account your unique financial situation, goals, and tax considerations. If you're ready to take control of your retirement income and create a tax-efficient distribution plan, we invite you to schedule a free consultation with one of our experienced financial advisors. We'll take the time to understand your needs and develop a customized strategy that helps you maximize your retirement income and minimize your tax burden. You can also sign up for our online dashboard to get a comprehensive view of your financial picture and track your progress toward your goals. Don't leave your retirement income to chance. Take action today and let Compound Planning help you achieve the retirement you want.